Let's move on and talk to Nitin Aggarwal, who's the analyst at Motilal Oswal and tracks financial space very closely. Nitin, thanks for your time. We were just talking, my colleague was talking about how the data on insurance has been pretty strong. What are your best risk-reward kind of bets in the insurance space? It has not really performed very well in the last 2 years at least.
Yeah. So certainly, last couple of years were quite challenging for the industry, and given back-to-back COVID waves and like the rising rates and volatile markets. So things are getting back on track. Though for life insurance, we still have to see how the numbers unfold in the coming months, because March was a very heavy month ahead of the budgetary changes, and that will have some bearing on the full year growth numbers. And April has turned out to be a pretty weak month for the industry. So my sense is that we can see some continuation of that trend in the near term, but longer term, because the overall penetration levels and the demographics will continue to support the growth, and it's a structurally a sector which can continue to see high teens growth. So which is where we continue to like the sector, and notwithstanding some near-term weakness in term numbers that can be there.
Okay, point taken, because LIC is something that you're still quite positive on despite the beleaguered state. You have a target price which I think is 35-40% higher from current market price. But I wanted to, Nitin, talk about the entire banking space as a whole, because if you look at the divergent moves that we are seeing at this point of time, the large cap banks have been underperforming, and it's the mid cap space which is seeing quite a bit of buying action. Do you expect this trend to continue for the rest of the year?
You are right. Some of the mid-sized banks have performed very well in the last 2 months or so. And I think the confidence in these names is getting better, because while there has been a general uptrend in terms of the banking sector earnings, and last 3 years, if you look at the CAGR growth in earnings has been in the range of 45 to 50%. And these banks have also participated in that uptrend, and they are also reporting very decent ROAs, which are going to improve further in the coming years. And so the valuation gap that sort of got widened, I think that we are seeing some narrowing of that with this performance in the recent months. And looking at how the numbers can unfold in the FY24 and FY25, I think there is more scope in terms of re-rating for these banks. So we expect continued performance from some of these mid-sized banks.
Expecting more re-rating to happen for the mid-sized bank, but for the whole sector, if I had to ask you, which is that re-rating candidate that you would bet on at this point of time, and maybe the top 2 or 3 stocks that you're recommending from the entire space, help us with those recommendations.
Yeah. So from the overall sectoral perspective, we have been pitching for ICICI Bank, HDFC Bank, mid-sized banks. We are liking Anderson Bank and IDFC first. Amongst PSUs, we have been pitching SBI and BOB, wherein we think that the numbers will keep on trending better. Already, most PSBs have reached 1% ROA or so. And looking at how the growth and even the credit quality, which is continuing to improve. Like there was this somewhere this notion that the credit cycle will start to show some signs of moderation, and therefore the credit cost will start to increase. But the pace and the levels of GNPs that these banks have reported in Q4 in the SMA books points towards further improvement in the coming quarters. So we expect that the credit cost, while it may inch up a bit, but the pace of increase will still be very controlled. And that will further drive an improvement in ROAs from where we are right now.
Nitin, your word on HDFC twins, because they have been stark underperformers. Of course, there's this overhang of merger, but for a long-term investor, isn't it a good time to buy these names?
Certainly, we because this is a stock which is undergoing merger. This is the largest merger in the private banking space, and so it's going to take a couple of years to play out, and for the numbers to come back to the usual pre-merge levels which HDFC Bank used to deliver, and which is where one need to take a long-term view. And while we remain confident in the merged entity will be able to grow at a healthy run rate closer to the run rate pre-merger, but ROEs and margins will take time to recover, and which is where I think the valuations are pretty much reflecting that. And as you go on from here and take a view of the forward years beyond FY25, then you will see that the numbers will start to come back towards the pre-merged entity, and that will drive a re-rating in the bank. So I think from a 2 to 3 year perspective, definitely HDFC Bank is our preferred pick in this space.
Might be a near-term, temporary impact on the earnings, but then it's expected to catch up over the next 2 years. I also wanted your take regarding IndusInd Bank. You did point out that it's one of the top bets in the mid-cap space, but the stock has run up considerably, right? A year ago, it was, around 800 rupee level. It's already around 1300. Do you expect a further material re-rating for the counter? And if yes, what kind of target should we anticipate on IndusInd?
Yeah. So IndusInd has done quite well because while if you look at the last 2 years, every quarter there was an uptick in the numbers of IndusInd Bank. The profit numbers were inching up every quarter for good 8-10 quarters in a row. But because of the bank specific developments or some of the other adverse news flow, the stock, the re-rating was not really happening at that pace. It was not following the earnings. And now that you are looking at the numbers to improve further, they are already coming closer to 1.92 ROA, and this number can move towards 2.1 in the coming year. And the valuations, if you look at, despite all this re-rating, is still close to 1.4, 1.5 times on the forward. So that still leaves a decent scope for re-rating from here. And some of their key stress points like MFI and CV, they have already acknowledged a significant part of pain, and the credit cost therefore has shown significant moderation over the last 2 years and will continue to moderate even in FY24. That will provide, that will continue to support earnings and the ROA recovery for the bank.
Right. Right, Nitin, on that note, we'll let you go. Thank you so much for joining us today.